There are at least 7 stock chart patterns that indicate a continuing trend. In this video, we will discuss these stock chart patterns one by one. Flags and pennants are short-term continuation patterns that mark a small consolidation before the previous move resumes. These patterns are usually preceded by a sharp advance or decline with heavy volume and mark a midpoint of the move. Sharp move. To be considered a continuation pattern, there should be evidence of a prior trend. Flags and pennants require evidence of a sharp advance or decline on heavy volume. These moves usually occur on heavy volume and can contain gaps. This move usually represents the first leg of a significant advance or decline, and the flag pennant is merely a pause. Flagpole. The flagpole is the distance from the first resistance or support break to the high or low of the flag pennant. The sharp advance or decline that forms the flagpole should break a trend line or resistance support level. A line extending up from this break to the high of the flag pennant forms the flagpole. Flag. A flag is a small rectangle pattern that slopes against the previous trend. If the previous move was up, then the flag would slope down. If the move was down, then the flag would slope up. Because flags are usually too short in duration to actually have reaction highs and reaction lows, the price action just needs to be contained within 2 parallel trend lines. Pennant. A pennant is a small symmetrical triangle that begins wide and converges as the pattern matures, like a cone. The slope is usually neutral. Sometimes there will not be specific reaction highs and lows from which to draw the trend lines, and the price action should just be contained within the converging trend lines. Duration. Flags and pennants are short-term patterns that can last from 1 to 12 weeks. There is some debate on the time frame, and some consider 8 weeks to be pushing the limits for a reliable pattern. Ideally, these patterns will form between 1 and 4 weeks. Once a flag becomes more than 12 weeks old, it would be classified as a rectangle. A pennant more than 12 weeks old would turn into a symmetrical triangle. The reliability of patterns that fall between 8 and 12 weeks is debatable. Break. For a bullish flag or pennant, a break above resistance signals that the previous advance has resumed. For a bearish flag or pennant, a break below support signals that the previous decline has resumed. Volume. Volume should be heavy during the advance or decline that forms the flagpole. Heavy volume provides legitimacy for the sudden and sharp move that creates the flagpole. An expansion of volume on the resistance, support, break lends credence to the validity of the formation and the likelihood of continuation. Targets. The length of the flagpole can be applied to the resistance break or support break of the flag pennant to estimate the advance or decline. Even though flags and pennants are common formations, identification guidelines should not be taken lightly. It is important that flags and pennants are preceded by a sharp advance or decline. Without a sharp move, the reliability of the formation becomes questionable, and trading could carry added risk. Look for volume confirmation on the initial move, consolidation and resumption to augment the robustness of pattern identification. The symmetrical triangle, which can also be referred to as a coil, usually forms during a trend as a continuation pattern. The pattern contains at least 2 lower highs and 2 higher lows. When these points are connected, the lines converge as they are extended and the symmetrical triangle takes shape. You could also think of it as a contracting wedge, wide at the beginning and narrowing over time. While there are instances when symmetrical triangles mark important trend reversals, they more often mark a continuation of the current trend. Regardless of the nature of the pattern, continuation or reversal, the direction of the next major move can only be determined after a valid breakout. We will examine each part of the symmetrical triangle individually. Trend. In order to qualify as a continuation pattern, an established trend, at least a few months old, should exist. The symmetrical triangle marks a consolidation period before continuing after the breakout. 4 points. At least 2 points are required to form a trend line and 2 trend lines are required to form a symmetrical triangle. Therefore, a minimum of 4 points are required to begin considering a formation as a symmetrical triangle. The second high, 2, should be lower than the first, 1, and the upper line should slope down. The second low, 2, should be higher than the first, 1, and the lower line should slope up. Ideally, the pattern will form with 6 points, 3 on each side, before a breakout occurs. Volume. As the symmetrical triangle extends in the trading range contracts, volume should start to diminish. This refers to the quiet before the storm, or the tightening consolidation before the breakout. Duration. The symmetrical triangle can extend for a few weeks or many months. If the pattern is less than 3 weeks, it is usually considered a pennant. Typically, the time duration is about 3 months. Breakout time frame. The ideal breakout point occurs 1/2 to 3/4 of the way through the pattern's development or time span. The time span of the pattern can be measured from the apex, convergence of upper and lower lines, back to the beginning of the lower trend line, base. A break before the 1/2 way point might be premature and a break too close to the apex may be insignificant. After all, as the apex approaches, a breakout must occur sometime. Breakout direction. The future direction of the breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of the breakout can be dangerous. Even though a continuation pattern is supposed to break out in the direction of the long-term trend, this is not always the case. Breakout confirmation. A break should be on a closing basis for it to be considered valid. Some traders apply a price, 3% break, or time, sustained for 3 days, filter to confirm validity. The breakout should occur with an expansion in volume, especially on upside breakouts. Return to apex. After the breakout, up or down, the apex can turn into future support or resistance. The price sometimes returns to the apex or a support-resistance level around the breakout before resuming in the direction of the breakout. Price target. There are 2 methods to estimate the extent of the move after the breakout. First, the widest distance of the symmetrical triangle can be measured and applied to the breakout point. Second, a trend line can be drawn parallel to the pattern's trend line that slopes, up or down, in the direction of the break. The extension of this line will mark a potential breakout target. In Technical Analysis of Stock Trends, 1948, Edwards and McGee suggest that roughly 75% of symmetrical triangles are continuation patterns and the rest mark reversals. The reversal patterns can be especially difficult to analyze and often have false breakouts. Even so, we should not anticipate the direction of the breakout, but rather wait for it to happen. Further analysis should be applied to the breakout by looking for gaps, accelerated price movements, and volume for confirmation. Confirmation is especially important for upside breakouts. Prices sometimes return to the breakout point of apex on a reaction move before resuming in the direction of the breakout. This return can offer a second chance to participate with a better reward-to-risk ratio. Potential reward price targets found by measurement and parallel trend line extension are only meant to act as rough guidelines. The ascending triangle is a bullish formation that usually forms during an uptrend as a continuation pattern. There are instances when ascending triangles form as reversal patterns at the end of a downtrend, but they are typically continuation patterns. Regardless of where they form, Ascending triangles are bullish patterns that indicate accumulation. Because of its shape, the pattern can also be referred to as a right-angle triangle. Two or more equal highs form a horizontal line at the top. Two or more rising troughs form an ascending trend line that converges on the horizontal line as it rises. If both lines were extended right, the ascending trend line could act as the hypotenuse of a right triangle. If a perpendicular line were drawn extending down from the left end of the horizontal line, a right triangle would form. Let's examine each individual part of the pattern and then look at an example. Trend. In order to qualify as a continuation pattern, an established trend should exist. However, because the ascending triangle is a bullish pattern, the length and duration of the current trend is not as important as the robustness of the formation, which is paramount. Top horizontal line. At least two reaction highs are required to form the top horizontal line. The highs do not have to be exact, but they should be within reasonable proximity of each other. There should be some distance between the highs and a reaction low between them. Lower ascending trend line. At least two reaction lows are required to form the lower ascending trend line. These reaction lows should be successively higher, and there should be some distance between the lows. If a more recent reaction low is equal to or less than the previous reaction low, then the ascending triangle is not valid. Duration. The length of the pattern can range from a few weeks to many months, with the average pattern lasting from 1 to 3 months. Volume. As the pattern develops, volume usually contracts. When the upside breakout occurs, there should be an expansion of volume to confirm the breakout. While volume confirmation is preferred, it is not always necessary. Return to breakout. A basic tenet of technical analysis is that resistance turns into support and vice versa. When the horizontal resistance line of the ascending triangle is broken, it turns into support. Sometimes there will be a return to this support level before the move begins in earnest. Target. Once the breakout has occurred, the price projection is found by measuring the widest distance of the pattern and applying it to the resistance breakout. In contrast to the symmetrical triangle, an ascending triangle has a definitive bullish bias before the actual breakout. If you will recall, the symmetrical triangle is a neutral formation that relies on the impending breakout to dictate the direction of the next move. On the ascending triangle, the horizontal line represents overhead supply that prevents the security from moving past a certain level. It is as if a large sell order has been placed at this level and it is taking a number of weeks or months to execute, thus preventing the price from rising further. Even though the price cannot rise past this level, the reaction lows continue to rise. It is these higher lows that indicate increased buying pressure and give the ascending triangle its bullish bias. The descending triangle is a bearish formation that usually forms during a downtrend as a continuation pattern. There are instances when descending triangles form as reversal patterns at the end of an uptrend, but they are typically continuation patterns. Regardless of where they form, descending triangles are bearish patterns that indicate distribution. Because of its shape, the pattern can also be referred to as a right-angle triangle. Two or more comparable lows form a horizontal line at the bottom. Two or more declining peaks form a descending trend line above that converges with the horizontal line as it descends. If both lines were extended right, the descending trend line could act as the hypotenuse of a right triangle. If a perpendicular line were drawn extending up from the left end of the horizontal line, a right triangle would form. Let's examine each individual part of the pattern and then look at an example. Trend. In order to qualify as a continuation pattern, an established trend should exist. However, because the descending triangle is definitely a bearish pattern, the length and duration of the current trend is not as important as the robustness of the formation. Lower horizontal line. At least 2 reaction lows are required to form the lower horizontal line. The lows do not have to be exact, but should be within reasonable proximity of each other. There should be some distance separating the lows and a reaction high between them. Upper descending trend line. At least 2 reaction highs are required to form the upper descending trend line. These reaction highs should be successively lower and there should be some distance between the highs. If a more recent reaction high is equal to or greater than the previous reaction high, then the descending triangle is not valid. Duration. The length of the pattern can range from a few weeks to many months, with the average pattern lasting from 1 to 3 months. Volume. As the pattern develops, volume usually contracts. When the downside break occurs, there would ideally be an expansion of volume for confirmation. While volume confirmation is preferred, it is not always necessary. Return to breakout. A basic tenet of technical analysis is that broken support turns into resistance and vice versa. When the horizontal support line of the descending triangle is broken, it turns into resistance. Sometimes there will be a return to this newfound resistance level before the down move begins in earnest. Target. Once the breakout has occurred, the price projection is found by measuring the widest distance of the pattern and subtracting it from the resistance breakout. In contrast to the symmetrical triangle, a descending triangle has a definite bearish bias before the actual break. The symmetrical triangle is a neutral formation that relies on the impending breakout to dictate the direction of the next move. For the descending triangle, the horizontal line represents demand that prevents the security from declining past a certain level. It is as if a large buy order has been placed at this level and it is taking a number of weeks or months to execute, thus preventing the price from declining further. Even though the price does not decline past this level, the reaction highs continue to decline. It is these lower highs that indicate increased selling pressure and give the descending triangle its bearish bias. A rectangle is a continuation pattern that forms as a trading range during a pause in the trend. The pattern is easily identifiable by 2 comparable highs and 2 comparable lows. The highs and lows can be connected to form 2 parallel lines that make up the top and bottom of a rectangle. Rectangles are sometimes referred to as trading ranges. Consolidation zones are congestion areas. There are many similarities between the rectangle and the symmetrical triangle, while both are usually continuation patterns. They can also mark trends' significant tops and bottoms. As with the symmetrical triangle, the rectangle pattern is not complete until a breakout has occurred. Sometimes clues can be found, but the direction of the breakout is usually not determinable beforehand. We will examine each part of the rectangle. Trend. To qualify as a continuation pattern, a prior trend should exist. Ideally, the trend should be a few months old and not too mature. The more mature the trend, the less chance that the pattern marks a continuation. 4 points. At least 2 equivalent reaction highs are required to form the upper resistance line and 2 equivalent reaction lows to form the lower support line. They do not have to be exactly equal, but should be within a reasonable proximity. Although not a prerequisite, it is preferable that the highs and lows alternate. Volume. As opposed to the symmetrical triangle, rectangles do not exhibit standard volume patterns. Sometimes volume will decline as the pattern develops. Other times, volume will gyrate as the prices bounce between support and resistance. Volume will rarely increase as the pattern matures. If volume declines, it is best to look for an expansion on the breakout for confirmation. If volume gyrates, it is best to assess which movements, advances to resistance or declines to support, are receiving the most volume. This type of volume assessment could offer an indication on the direction of the future breakout. Duration. Rectangles can extend for a few weeks or many months. If the pattern is less than 3 weeks, it is usually considered a flag, also a continuation pattern. Ideally, rectangles will develop over a 3-month period. Generally, the longer the pattern, the more significant the breakout. A 3-month pattern might be expected to fulfill its breakout projection. However, a 6-month pattern might be expected to exceed its breakout target. Breakout direction. The direction of the next significant move can only be determined after the breakout has occurred. As with the symmetrical triangle, rectangles are neutral patterns that are dependent on the direction of the future breakout. Volume patterns can sometimes offer clues, but there is no confirmation until an actual break above resistance or break below support. Breakout confirmation. For a breakout to be considered valid, it should be on a closing basis. Some traders apply a filter to price, which is 3%, time, which is 3 days, or volume, expansion, for confirmation. Return to breakout. A basic tenet of technical analysis is that broken support turns into potential resistance and vice versa. After a break above resistance, or below support, there is sometimes a return to test this newfound support level, or resistance level. For more detail, see our videos in the playlist. A return to or near the original breakout level can offer a second chance to participate. Target. The estimated move is found by measuring the height of the rectangle and applying it to the breakout. Rectangles represent a trading range that pits the bulls against the bears. As the price nears support, buyers step in and push the price higher. As the price nears resistance, bears take over and force the price lower. Nimble traders sometimes play these bounces by buying near support and selling near resistance. One group, bulls or bears, will exhaust itself and a winner will emerge when there is a breakout. Again, it is important to remember that rectangles have a neutral bias. Even though clues can sometimes be gleaned from volume patterns, the actual price action depicts a market in conflict. Only until the price breaks above resistance or below support will it be clear which group has won the battle. A price channel is a continuation pattern that slopes up or down and is bound by an upper and lower trend line. The upper trend line marks resistance and the lower trend line marks support. Price channels with negative slopes, down, are considered bearish and those with positive slopes, up, bullish. For explanatory purposes, a bullish price channel will refer to a channel with positive slope and a bearish price channel will refer to a channel with negative slope. Main trend line. It takes at least 2 points to draw the main trend line. This line sets the tone for the trend and the slope. For a bullish price channel, the main trend line extends up and at least 2 reaction lows are required to draw it. For a bearish price channel, the main trend line extends down and at least 2 reaction highs are required to draw it. Channel line. The line drawn parallel to the main trend line is called the channel line. Ideally, the channel line will be based off of 2 reaction highs or reaction lows. However, after the main trend line has been established, some analysts draw the parallel channel line using only 1 reaction high or low. The channel line marks support in a bearish price channel and resistance in a bullish price channel. Bullish price channel. As long as prices advance and trade within the channel, the trend is considered bullish. The first warning of a trend change occurs when prices fall short of channel line resistance. A subsequent break below main trend line support would provide further indication of a trend change. A break above channel line resistance would be bullish and indicate an acceleration of the advance. Bearish price channel. As long as prices decline and trade within the channel, the trend is considered bearish. The first warning of a trend change occurs when prices fail to reach channel line support. A subsequent break above main trend line resistance would provide further indication of a trend change. A break below channel line support would be bearish and indicate an acceleration of the decline. Scaling. Even though it is a matter of personal preference, trend lines seem to match reaction highs and lows best when semi-log scales are used. Semi-log scales reflect price movements in percentage terms. A move from 50 to 100 will appear the same distance as a move from 100 to 200. In a bullish price channel, some traders look to buy when prices reach main trend line support. Conversely, some traders look to sell or short when prices reach main trend line resistance in a bearish price channel. As with most price patterns, other aspects of technical analysis should be used to confirm signals. Because technical analysis is just as much art as it is science, there is room for flexibility. Even though exact trendline touches are ideal, it is up to each individual to judge the relevance and placement of both the main trend line and the channel line. By that same token, a channel line that is exactly parallel to the main trend line is ideal. The cup with handle is a bullish continuation pattern that marks a consolidation period followed by a breakout. It was developed by William O'Neill and introduced in his 1988 book, How to Make Money in Stocks. As its name implies, there are two parts to the pattern, the cup and the handle. The cup forms after an advance and looks like a bowl or rounding bottom. As the cup is completed, a trading range develops on the right-hand side and the handle is formed. A subsequent breakout from the handle's trading range signals a continuation of the prior advance. Trend. To qualify as a continuation pattern, a prior trend should exist. Ideally, the trend should be a few months old and not too mature. The more mature the trend, the less chance that the pattern marks a continuation or the less upside potential. Cup. The cup should be U-shaped and resemble a bowl or rounding bottom. A V-shaped bottom would be considered too sharp of a reversal to qualify. The softer U shape ensures that the cup is a consolidation pattern with valid support at the bottom of the U. The perfect pattern would have equal highs on both sides of the cup, but this is not always the case. Cup depth. Ideally, the depth of the cup should retrace 1/3 or less of the previous advance. However, with volatile markets and overreactions, the retracement could range from 1/3 to 1/2. In extreme situations, the maximum retracement could be 2/3, which conforms with Dow theory. Handle. After the high forms on the right side of the cup, there is a pullback that forms the handle. Sometimes this handle resembles a flag or pennant that slopes downward. Other times it is just a short pullback. The handle represents the final consolidation, pullback before the big breakout and can retrace up to 1/3 of the cup's advance, but usually not more. The smaller the retracement, the more bullish the formation and significant the breakout. Sometimes it is prudent to wait for a break above the resistance line established by the highs of the cup. Duration. The cup can extend from 1 to 6 months, sometimes longer on weekly charts. The handle can be from 1 week to many weeks and ideally completes within 1 to 4 weeks. Volume. There should be a substantial increase in volume on the breakout above the handle's resistance. Target. The projected advance after breakout can be estimated by measuring the distance from the right peak of the cup to the bottom of the cup. As with most chart patterns, it is more important to capture the essence of the pattern than the particulars. The cup is a bowl-shaped consolidation and the handle is a short pullback followed by a breakout with expanding volume. A cup retracement of 62% may not fit the pattern requirements, but a particular stock's pattern may still capture the essence of the cup with handle.